This is Tom Rowlands-Rees, and you're listening to Switched On, the podcast brought to you by Bloomberg NEF. Each year, Bloomberg NEF publishes the Energy Transition Investment Trends, which for nearly 2 decades has tracked where money is actually flowing across clean energy sectors, cutting through hype and narrative to provide a clear, comparable picture of global investment. This year's report shows that total energy transition investment reached a record $2.3 trillion in 2025, up 8% year on year, even as growth has slowed from the rapid expansion seen earlier in the decade. But the story is more nuanced than a single headline number. Renewable energy investment dipped globally, driven largely by policy changes in China, while sectors such as clean industry and carbon capture saw renewed momentum. Regionally, the balance shifted again, with growth in Europe, the Middle East and Africa offsetting softer investment in China, underscoring just how dynamic this global race remains. And understanding these shifts means looking beyond the headline figure itself. On today's show, we also step behind the scenes to examine how the numbers come together, from defining what qualifies as transition investment to deciding when capital is truly committed, to reconciling everything from EV purchases to nuclear construction and green debt issuance. Turning such complexity into a clear, consistent global total requires careful judgment, and we unpack that process as part of the discussion. Joining me to review this year's energy transition investment trends is BNEF's Deputy CEO, Albert Cheung, and BNEF clients can find this note by heading to BNEF Go on the Bloomberg terminal or bnef.com. And if you're not yet a BNEF subscriber, you can find a free report summary at about.bnef.com. If you'd like to learn more about how BNEF approaches strategy research on the energy transition, including developments in commodity markets, trends across different sectors, and the cross-cutting technology shaping the future, you can find more information on bnef.com. And if you'd like to speak with a member of our team about becoming a client, email us at sales.bnef@bloomberg.net. But for now, let's dig into the data behind this year's energy transition investment trends. Albert, welcome to the podcast.
Thanks for having me, Tom.
So we're here to talk about the Energy Transition Investment Trends report and some of our findings. This is something we do every year, and I'm sure a lot of our regular subscribers, as well as people, we do put some of these findings out on our public website, so even our non-subscribers are familiar with this work. But for those that aren't, could you just tell us a little bit about what Energy Transition Investment Trends is?
Sure. Thanks, Tom. Yeah, Energy Transition Investment Trends is an annual report. We do it every January, as you say. We've been doing this in some shape or form really for 2 decades. And over the time, it's really become one of the most important things we do, in my opinion, because energy transition and the energy sector in general is a place full of people's assumptions and narratives and priors and a lot of hype as well. And what we do with this report is we really track where is the money actually flowing in these clean energy sectors, which technologies are attracting money, which are growing, which aren't, and how is that differing by geography. And by doing so, I think it provides a really important baseline to begin the year of where are we actually globally in the energy transition, what's going well and what maybe isn't going so well.
So, let me just ask you back that question you just rhetorically asked yourself. Where are we in the energy transition right now? What did the latest report tell us?
Okay, so last year we tracked a total of $2.3 trillion of investment and spending into the deployment of energy transition technology. So $2.3 trillion in 2025. It's an all-time record, which is great to see. And it was 8% higher than the year before. So in a moment when there are a lot of headwinds in the energy transition, there's policy change, particularly in the US, but also in other markets, trade tensions, rising geopolitical tension, we see that energy transition remains resilient, keeps growing. Now, that growth rate isn't as high as it used to be. So when I look back at 2021, so 4 years back in the data, that year we tracked 27% annual growth, and that growth rate has gradually sort of been declining to the point where it's now 8% below double digits. So I think there's always a glass half full, glass half empty story, and I think this year it is that we are at a record, but we've also dipped below a double digit growth.
In very simplistic terms, the fact that it's still growing, but it's not growing as much, and there's been all sorts of headwinds, are we seeing sort of momentum that's carrying over from the era where there were policy tailwinds more so, and that, we were seeing 27% growth? Is this an indication that this is going to flatline or potentially decline at some point in the near future? Or is it more just a sort of a maturing? Certain things maybe, nothing can grow at 27% a year forever, right? Even if it's a wild success, it has to tail off. So do you get a sense of where we are? Which of those is the truer description of this 8%?
Thanks. So I tend to subscribe more to the sort of second side of your reasoning, which is that things don't grow at 27% forever. And I think, when we look at the mature parts of the transition, which is, if you think about solar and wind and EVs, which are, really established sectors at this point, they're reaching this point where the barriers to further growth are more complicated than they were at the beginning. Solar is reaching certain penetrations in markets where it's hard to add more. So to add more renewables in some markets means adding storage and grids. And so you're going to see growth rates slow. On the EV side, you've done the innovation and early adopter phase of EV adoption, and now you're into the majority where the technology needs to be cheap and it needs to work, and we need to get to a point where EVs are at upfront cost parity with internal combustion engines to unlock that next phase of growth. So I tend to subscribe more to the view of, as sectors mature, they're large, they're established, they don't grow as quickly, but there's also a lot of complexity within that. And I think what we've seen in this report, I think we're going to talk about countries later, is that the country level story changes from year to year and is increasingly fragmented with different stories playing out in different regions as well.
I think when we're talking about those mature technologies as well, another thing that I think we sometimes can lose sight of is that behind the figures in terms of investment is cost declines are also happening. So the actual volume of widgets being installed or the increase in that is potentially higher if the costs have come down. And sometimes a slowdown in investment is also indicative of falling costs. Do you think that's a factor here?
It's a factor. It has been a bigger factor in the past. So what I will say is there have been years in the past in this data set where you could see investment flatlining or potentially slowing in some areas. And you could say that's because costs are coming down. The capacity being financed is actually still growing. This year, we've seen a bit less of that because the cost reductions are simply not what they used to be. And actually, we've just put out our levelized cost of electricity report as we record this. And what we find is that some of the key clean energy sectors actually became more expensive on an LCOE basis last year. One sector where we are seeing that exact effect, though, and we're still seeing it, is in energy storage, where we've seen very rapid cost reductions last year and the year before. And within that, energy storage investment is still rising rapidly. So the investment would probably be rising even more rapidly if the costs had not fallen so much.
Got it. So the mature sectors, still robust, maybe, as you say, beginning to saturate. The less mature sectors, were there some that stood out as still kind of showing the growth that we were seeing a few years ago, and are there others that are maybe have had less good 2025s?
Before I go into the sort of less mature sectors, it's worth pointing out that actually renewable energy investment did drop in 2025. It dropped about 9.5%, and it's still a substantial sector. So it was about 690 billion in 2025, and that puts it in second place. EVs and the whole electrified transport ecosystem is 890 billion and growing quite strongly. Renewables fell off in 2025. And that was particularly because in China, there was a power market rule change that introduced more power price risk into the investment calculus for renewable energy projects. And that happened at the mid-year. And so projects in China were sort of front-loaded into the first half of the year, and then investment fell off in the second half. And that actually led to a decrease in investment in China and globally as well. And I think that's a really good example of this point we were just talking about, where things can't grow at an astronomical rate forever, because at some point the sort of technocratic and bureaucratic and market-driven things kick in.
So the decline in investment in renewables was driven in large part by those policy changes in China. If you took China out of the picture and talked about the rest of the world excluding China, did the renewable investment go down, or was it actually increasing? I mean, so I suppose my question is this decline that you saw in renewable energy investment just because of China and that rule change, or was there equivalent things happening across the board elsewhere?
No, the global drop was driven by China. And if you took China out of the data, renewable energy investment globally continued to grow in 2025 as it has been over the last few years. So it was a change, a turnaround for the books, let's say, in China, which drove down the global number. But a lot of other markets continued to see growth. I'm not going to say every single one, but yeah, globally, ex-China, it was a strong year for renewable energy investment. And it was also a strong year for offshore wind, which again, the rhetoric would have you believe offshore wind's having a terrible time, but it was a really strong year for offshore wind, particularly in Europe, where there were some large projects that reached financial close.
That's what I love about this report, is that it so often provides a counterpoint to the rhetoric, which is often not grounded in fact. And it just provides some actually very straightforward facts.
Yes.
What's actually happening. Meanwhile, in the real world, BNEF says...
Exactly, Tom. And that's part of the reason our team, we really enjoy doing this report because, first of all, it's a very intense project in the first few weeks of January. But secondly, we don't know the result. It's a report where you just don't know what the results are going to be until you get right to the very end. And there's a certain amount of suspense in the team. There's different bets going on internally on what the numbers are going to look like, which is exciting.
It's kind of like almost like Groundhog Day when they bring out the groundhog and they're like, oh, it's going to be a snowy year, or oh, it's going to be a sunny year. Like, we don't know what the outlook is until the moment comes. I know this is a backward looking report, but still. So we were talking about some of the less mature sectors. What were some of the different stories you see in the data for those?
So in terms of what we call emerging sectors, and we have a chart in the report on this, we include 6 areas in under the sort of emerging sectors bucket. So that's nuclear, carbon capture and storage, CCS, hydrogen, clean shipping, which is essentially vessels which can run on net zero fuels, electrified heat, which is building heat pumps, and then clean industry, which is everything around industry decarbonization. So 6 areas. And last year, when we tallied up the 2024 data, we actually saw a significant drop in investment in those areas. And we'd sort of taken that as a signal that, look, this basket of areas that we've bucketed as emerging, they've not reached cost competitiveness yet. They require long-term, stable and strong policy support. And when that policy support wavers, then investment drops. And we still think that's the case. But the good news is investment in those sectors actually grew in 2025. So they grew 7%, which is a bit less than the overall 8% across all sectors, to $172 billion. And that 172 billion is about 7.5% of the overall 2.3 trillion that we spoke about earlier. So 7.5% is not very much. So I think the point here really is that those emerging sectors remain pretty small compared to the overall volume of money that's going into areas like renewables and EVs and grids and energy storage. But at least this year, they trended in the right direction. And there were a couple of drivers for that. One was the return of clean industry investment. We saw some clean steel production projects attracting finance, particularly in Asia, which was great to see. And we also saw a big uptick in CCS projects on a relatively small base. So they're not big numbers, but it was order of magnitude, I think it was something like a 60% increase in CCS funding last year, driven by projects in Europe and the Middle East as well. So I think these sectors are going to be very important to watch over the next 5 years. We know that they need to scale up between now and the early 2030s if they're going to have any impact on kind of climate goals and wider decarbonization. So it's good to see those moving in the right direction.
It's really interesting that those two are seeing investment, and they're seeing investment. I'm saying this, I'm sitting in New York, outside of the US, because, with these policy headwinds that we're seeing in the US, one of the questions I have asked both myself and others is the US potentially going to miss out on some of these industries of the future that's actually quite well positioned on paper to benefit from? And, if in the long term, the future of steel is green steel, and if in the future the carbon capture and storage becomes a major plank to different countries' energy strategies, then it's sort of all to play for. If it's, if CCS projects are happening in Europe and the Middle East, those are regions that don't currently export a lot of energy tech. So it also speaks to me a little bit of that there's a playing field that's maybe opening up a little bit in certain areas.
Yeah, I would agree with that. And actually, funnily enough, you mentioned that you sit in the US. The US happens to be a leader in electrified steel production and also a leader in carbon capture and storage. Most of the existing CCS projects today are in the US, and a lot of the pipeline out of the next few years is in the US as well. So there's every opportunity for the US to continue to lead in those areas. If we can see that those projects really, really do come to fruition and don't fall off the pipeline with all of the policy uncertainty that's going on over there.
No, I like I said, I think the US is very well positioned to own some of the, particularly carbon capture and storage as well. So who didn't do so well in these emerging areas?
So we saw a downtick in hydrogen investment. Hydrogen was down about 20% year on year. And I think the headwinds have been very well documented in the hydrogen sector. Certainly, the policy changes in the US haven't helped, but more broadly, there's just been a lack of demand for hydrogen and clean hydrogen and its derivatives. We also saw a slight drop in global nuclear investment, and that might be counterintuitive to some of your listeners, only because we hear a lot about attention on new nuclear projects and new nuclear technologies. The reason nuclear dropped last year was because a couple of big projects in Europe and the US came to completion last year, and so in our data set they drop off the investment modeling, I suppose, because the investment's over. And so without new projects of the same scale, very large projects beginning construction in the same year, you get that drop off in investment. So I think all of the discussion we're having now about nuclear uprates, new SMR projects, all of that will start to figure into the data over time. It may not replace some of these very large projects that have been completed. I think it will be quite a lot of time before SMRs make the same amount of impact on investment. But I don't think we're saying nuclear's got negative momentum or anything like that. It's more just some projects got completed.
I think it's a really interesting point that we, both in a positive and negative sense, we still have to read between the lines on the data. We can't be like, oh, something is growing a lot, therefore its future is bright. Something didn't do so well this year, therefore it's over for that technology. Because sometimes there's very good reasons, and in nuclear there's this kind of potential transition from the past to the future in terms of technology, and the future at some stage is always going to be a much smaller volume of investment into new technologies compared to large assets being deployed.
Yeah, agreed with that completely.
So were there any strong regional stories that stood out when you kind of looked at all the results?
Yeah, I thought the regional story this year was so interesting because a year ago, again, when we looked at 2024, what we found was that most of the growth in global energy transition investment had been driven by Asia Pacific and China in particular. And the US and Europe, EMEA regions had been basically flat that year. So we were sat on a data set that said all the growth is coming out of APAC. This year, I've already told you that China invested less year on year. So China's total investment across all of energy transition, I think, dropped by about 3%. And the growth that I mentioned, the 8% growth globally, was actually primarily driven by Europe, Middle East, and Africa, which was a real turnaround. And then other parts of Asia, especially markets like India, where you see high growth. So for me, that just really underscores that from one year to the next, these stories change, and you have to update your assumptions, you have to update your priors. And then also, it was not long ago at all when I remember sitting in discussions in Europe and the UK, and people were terrified that all of the energy transition investment was going to be sucked out of Europe and over into the US. And instead, here we are talking about, 20-odd% growth in the EMEA region. The UK grew 36% last year off the back of some very large offshore wind deals. So again, the winds can change very, very quickly. And that's just another good reminder for us.
That's so interesting. I mean, I remember the world of a few years ago as well. And again, as a Brit based in the US, I was speaking to primarily US audiences and talking about the impact of the Inflation Reduction Act. And you looked at the numbers and the narrative was really clear. Is, if your thesis is that the energy transition is the future, which for me, that is the thesis, despite the various headwinds and challenges to that, I was kind of framing it as a race to get there. And I said, China is, miles ahead. The US is picking up momentum, and oh dear for Europe, is sort of not really in it. And now, with investment in China faltering, the US not continuing the momentum that it was supposedly going to establish, certainly that Europe is back in the game. And that's it. It's a real turnaround. And, obviously China is still way in the lead on this. So let's not, delude ourselves. But again, it kind of maybe comes back to this thing I said earlier, that there's everything to play for here.
Absolutely. And so it's true that China is in the lead. China invested $800 billion out of the $2.3 trillion last year globally. So really impressive and far out front in the lead as an individual market. But to your point about the race, if there is a race going on, if you add together the US, the European Union, and the UK, these three markets, and let's say you call that the West, which is an oversimplification, but imagine that's the West. That West group invested more than China last year, which not a lot of people would necessarily have appreciated.
And is that the first time we can say that?
It isn't, but it gets more interesting. So that had not been the case in 2024. So in 2024, China invested more than that West group. And actually, as we look back over the last 4 years, that lead between China and the West has changed hands every year since 2021.
So yeah, it's this kind of reminds me, if you ever tune in to the TV and they're playing polo, and it's always international polo is Argentina versus the rest of the world. If this is, it's sort of China versus the West, that seems like maybe a good way of framing the kind of the nature of the competition right now. And when you frame it like that, it seems like it's a real tussle at the top.
Yeah, for sure. I mean, it certainly makes the race more interesting when you can identify two groups that are neck and neck and changing hands every year. So it certainly keeps it interesting for us.
It's so interesting being able to pull out some of these insights. And I think the beauty of ETIT is it distills all of the complexity, all of the narratives down into some very comparable numbers of things that are normally not easily comparable. And the thing that's maybe sometimes deceptive about that is because of maybe the simplicity of what we present, it makes it seem like then it was a simple process. But I actually think that there's an inverse relationship there. Is the simpler the output, the more complexity had to be taken on in the back end to try and give people that simplicity. Because, using the simple example, and this is the one I'm familiar with, I know that in the investment numbers for electric vehicles is based on how many electric cars are sold, or not just electric cars, but it's based on the sort of purchases of vehicles versus, asset development of large scale, say, nuclear projects. That they don't exist in the same world. And we through our methodologies, bring them onto the same playing field so that they can be compared. Can you just talk us, I've given this one example, but can you just talk us through some of that complexity, the decisions you have to make, how you do it? Because it's really easy to say, yeah, let's total up investment in the energy transition worldwide. But as I think once you've said that and you start digging into it, you suddenly realize that, even before you collect the data, there's a bunch of sort of meta decisions you need to make, a bunch of definitions you have to decide. Where do you start with that?
That's such a huge question. I can try and have a go at it, and then maybe we can dig a bit deeper. There's one element maybe of that that's really important is the timing of money, because actually an investment decision in all these different sectors can mean a slightly different thing. And our North Star for this project is to try and reflect the moment when the money is committed to a project. But that simple ideal turns out it's quite different in different areas. So in renewable energy, for example, our team is tracking an asset finance decision. So if a project is financed, like receives debt financing, then it's considered financed in that year. Or if it signs a procurement contract, then it's considered financed, because you can imagine that the developer is at that point committed to the project.
Right. So even if the money is spent over several subsequent years, we are counting it for a particular year.
Exactly. So that project may come to fruition 3 years after. We're tracking it as an investment decision, and the money being spent is spread over those years, but we track it as an investment in that year, and we put all the capex in that year.
It makes sense. There's no perfect answer to this question of, when you're going to count that money, but I think I like the idea of this North Star that's based around when do you decide to spend the money? Commit, I suppose, is the better word. When do you commit to spending that money? Exactly.
And to your earlier examples, that looks totally different in the EV sector and the nuclear sector. So for EVs, that commitment to buy an EV is a consumer purchase. So we look at EV sales in a given year and investments in charging infrastructure in a given year and so on. But for nuclear, it's different again, because our nuclear team is obviously tracking all of the reactors under construction and restart around the world. But those projects can seem like they're fully committed, but then get paused or cancelled or delayed or whatever it may be over the course of
overruns.
Or there's cost overruns. Yeah.
Where do you count that in the data?
Yeah, no, exactly. So our nuclear team takes a view that you should spread the money over the 5, 6, 7 years that it takes to build the project, because the project may get killed after 2 years. So in nuclear, we don't take all the money and put it in the year of commitment. So you have to make all of these, and there's sort of even just this issue of timing of money. There's probably 20 decisions we've had to make to try and get it to be as apples to apples, or at least as fair to the sector and its context as possible.
That's so interesting. I've got a few other questions about the methodology. One is, as you well know, me and Albert have worked together for a very long time. Albert was my first manager at BNEF, and I was covering energy efficiency. And one of the things I struggled with sometimes when I was trying to add up numbers, say how much was invested in energy efficiency, is, the ambiguities. In energy efficiency, the example I'd be is, if someone's bought energy efficient lighting, to what extent is that an investment in energy efficiency, and to what extent is an investment in lighting? How much should we say was specifically invested in the efficiency part? I'm sure there's multiple ambiguities that you come across in this project. Is that fair to say? And how do you deal with those ambiguities?
Well, energy efficiency is a great example. We have tried, and Tom, you've been a big part of that over the years of getting to a good understanding of what energy efficiency investment means. And actually, for the purpose of this energy transition investment project, we haven't been able to include it, apart from in the sense of electrification, heat pumps, EVs, and so on, simply because it's too difficult to get to a set of definitions and methodology that truly is defensible in our view. And I know there are other groups that do it, but we just haven't been able to get comfortable ourselves. I think some of the trickier things maybe relate to industry, for example. So we've had to make a decision as to what's included in our clean steel investment numbers. And, we include electric arc furnaces that are being built that may or may not run on clean electricity in the first year. And maybe in future they will, maybe they don't at the beginning. There are direct reduction furnaces that are hydrogen capable that are in the data set that we don't know if they'll be run on hydrogen at the beginning. And so we've made some decisions around inclusion of those assets where we feel that those investments wouldn't be stranded in a net zero world, or they are not directly emitting and could run off a clean fuel. Same thing with dual fuel shipping vessels, which can run on a conventional fuel and a net zero fuel. We've made decisions to include those kinds of things. So there are judgment calls that one has to make with this sort of thing, and we have to make sure that it's useful and usable to the folks who are using our research.
And so from our understanding, the delineation we use is technology based. So there's a sort of a binary. We're either counting a technology or we're not. Like heat pumps are in. We're not making this. How much of this would have happened anyway is just an investment in heating versus an investment in energy efficient heating, as opposed to like us trying to either look at, say, the business models behind it, which I know for energy efficiency was one way you'd try and make that delineation, which also has its shortcomings. And we're not trying to do anything clever like, if it's a dual fuel ship, we'll count it as 50%. We're basically saying either a technology is in and we count it and we're transparent about it and we'll tell you how much of those we're invested in, or it's not. Is that fair to say that we use a sort of a technology-based delineation and we make a decision on technologies on a case-by-case basis?
Yes, that's right. And it's important to us that we're transparent about those choices. So we have to be clear in the methodology of what we're including. And I think, there's one more example which I think really illuminates that choice, which is on power grids, which, Tom, as you know, in our power grids investment figure, we include all grid investment at the transmission and distribution level in all of the markets that we track, regardless of whether or not those projects are explicitly for a green or energy transition purpose. So it's almost certain that we're including power grid investment that connects fossil generation. And there's a few reasons we do that. I mean, one is to this point about transparency. There comes a point when you can overcomplicate. And if you overcomplicate and you say, well, that country's only got 30% renewables, so we're going to take 30% of its power grid investment and include it and exclude the other 70%. The question you hit up against there is that still useful?
I was about to say, what use is that? Who's going to make use of it? It's academically useful. It's useful for people having arguments on Twitter, on X, but it's not useful for anyone making decisions.
Exactly. So there's a risk of sort of inadvertently obfuscating the numbers that you're actually trying to illuminate. But with that said, there are groups out there. There's a Green Grids Initiative, the Utilities for Net Zero Alliance, who are working on this question of, well, what constitutes a green grid investment? Can you build a taxonomy around it so that finance can flow to those projects? I think that's very worthy work. And we support that kind of work. It's just that when you're trying to produce a consistent report, the most important thing is transparency and clarity, and maybe perfection is a little bit too far.
Yeah, I think it's important to be transparent about this stuff, but also not to overcomplicate it, because that still gives people the room to reinterpret the results along what they believe is right. Another question on the sort of the methodological side of things. We've talked a lot about where the money is going. I know there's this whole flip side to the report around where the money's coming from. So we're talking about things like different forms of green debt. There's also venture capital, M&A. How do we make sense of all of that? Again, it's all very different kinds of money, and not necessarily easy to just stack up and add together, even though it should simplistically, it should be. When you dig into the details, it's not. What are some of the challenges there?
Thanks, Tom. Yeah, this is it's a really interesting question. So what we do track in the report is equity fundraising by climate tech companies, which was about $77 billion in 2025 and up very strongly, up 50% after dropping for 3 years. So that was great to see. So that's the equity side or private investment. The other thing we do track is debt issuance by companies, governments, and projects where the debt is being issued for an energy transition related purpose. So we think that money is being then used by the government or the project or the company to build a project or ramp up manufacturing or some other thing that's energy transition related. And that was $1.2 trillion in 2025 and up 17%. So those are two of the key things in my view when it comes to kind of the financial markets that underpin the energy transition. I mean, the first thing to say is people can sometimes be surprised just how much greater the debt number is than the equity number because there's so much hype around venture capital and private equity and IPOs and so on of companies in the climate tech space. But it's really a drop in the ocean compared to the amount of debt being raised especially by utility companies, energy companies, which is then being deployed into energy transition sectors.
Debt it might be boring, but it's a sign that your sector is mature or maturing, right? And that's a lot of that's going into the assets.
Exactly. It's financing the factories that make the batteries and EVs and so on, and the grids and all the rest of it. Those numbers, so the 1.2 trillion of debt, the 77 billion of equity, they don't add up to the same amount that's going into energy transition and supply chains. And there's lots of reasons for that. But let's pick on one or two of the key reasons. One is there's a lot of kind of just government subsidy and grant and other investment that is separate. And then there's a huge chunk of consumer spending that goes in as well. And that's consumers buying rooftop solar and heat pumps and EVs, which isn't reflected in your equity and debt financing and just is a different source of spending.
I was going to say, if you were to subtract the investment in electric vehicles from your total, then I'm sure your two figures of where the money's coming from and where it's going to would come a lot closer to adding up.
Yeah, if you adjusted all the scope of sectors and things, you get a lot closer, but you'd still have issues around timing where money raised in 1 year might not be spent until later on, et cetera, et cetera. So you'll never get it quite right, but you'd get a lot closer.
And are there any? I mean, you mentioned climate tech equity finance jumped 53% to 77.3 billion. Is that a new high, or is that sort of a recovering from a low base?
It's a recovery. It basically recovers more or less 1 year's worth of losses. So it gets us almost back to where we were in 2023. And it's still, I think, less than half of the figure that we saw back in 2021. So no, it's definitely not a new record or anything like that, but it's the beginning of a recovery. And what else was interesting about that is that most of that is in the public markets. It's established players like Iberdrola, BYD, CATL, raising capital in the public markets to invest at scale. And the early stage and mid stage venture capital private equity side of the equation continued to decline in 2025, actually. So we saw this slightly K-shaped recovery where public markets went first. That may pave the way for more venture capital and private equity to flow in the coming year, but that remains to be seen.
So I suppose one last question for me, 2026, obviously I'm not asking you to predict what our results are going to show, but do we have any ideas of things we might change in the report, things we might add in, things we might refine? You know, since we ended up talking a lot about the sort of the methodology behind this, I'd be kind of curious to know what the team's thinking is on, where to next in that regard.
It's a great question, and I wish I could answer it. But honestly, we're at the moment, I think 3 or 4 weeks post-publication. We're still talking to clients about the findings and explaining what's happened and kind of discussing what it means for our clients. So it's a little bit too early, honestly, to say what the next year will bring. But every year we look to improve. We refine methodologies, we adjust scope. We didn't talk about it too much, but this year we included a little bit more on data centers, a little bit more on adaptation and resilience as well. Just, small tweaks here and there. So I'm sure there'll be opportunities. So if people have ideas, they should definitely come and speak to us.
That's very fair. And, for those of us that you kind of curious about how we make decisions, our client feedback is hugely important to us in terms of people saying, I think that this would be an interesting thing to look at, or, I felt this was missing. We're not just going to do everything people suggest, but we don't just pool our ideas internally. We're always willing to hear suggestions of, how to expand. I think the adaptation piece will be really interesting to track and to see that flesh out. I'm sure that's going to be more and more important over the years.
Yeah, exactly. It's the flip side of the coin and doesn't get nearly enough attention. So we'll be spending more time on that for sure.
And then over the years, if we look at the history of ETIT, it started out just being renewables investment. But then I remember, we added EVs, and then at some point we added grids, which means that, we always caveat with our historical time series that you have to be slightly aware of that when comparing over the years, that some years have more stuff included. But I'm sure there'll be more things added in over time. And we don't necessarily, at this point in 2026, know exactly what those will be. But as this space evolves, there'll be more scope for us to put new things in.
Definitely. So our ideas on a postcard, and we'll consider everything.
Albert, it's been really fascinating both to hear about what the latest report is telling us and also just to get your perspective on how the sausage is made. Because, as I said, it all seems so simple when everything is condensed down to a number. And that's the joy of it, is we can start making some conclusions. But the condensing it down to a number is far from straightforward. So thank you for explaining all of that. And, a big shout out to the team that did all of that work.
Thanks, Tom. It's an absolute pleasure to chat to you about it. And look, there's about 70 analysts at BNEF who work really hard in the months leading up to this report. So absolute tribute to them. And thanks for having me today, Tom.
Thanks, Albert.
Today's episode of Switched On was produced by Cam Gray with production assistance from Kamala Schelling. Bloomberg NEF is a service provided by Bloomberg Finance LP and its affiliates. This recording does not constitute, nor should it be construed as investment advice, investment recommendations, or a recommendation as to an investment or other strategy. Bloomberg NEF should not be considered as information sufficient upon which to base an investment decision. Neither Bloomberg Finance LP nor any of its affiliates makes any representation or warranty as to the accuracy or completeness of the information contained in this recording, and any liability as a result of this recording is expressly disclaimed.